Hello, friends. Welcome to Income Sense channel once again. And today we are going to share a very interesting video on how to do investments in mutual funds. Most of us in today's time we invest in mutual funds, and it is very important for us to know what are some of the qualitative factors and some of the quantitative factors which we should consider before doing a long term investment into mutual funds. Some of us do contact our friends, we hear some grapevine, we look at some videos, we look at materials, and we take our decisions. But this video will tell you more about how scientifically and in a very simple way you can actually go and invest in mutual funds for a long term horizon in order to achieve your long term goals and objectives. On that note, let's get started. So now friends, let's look at some of the factors which we should review before investing in mutual funds, and this is proudly presented by the Income Sense team. Before we actually proceed, we want to provide you a small disclaimer that these discussions in the video are purely for educational purposes. We do not endorse or promote any of the discussions herein, and the past performance of any product or fund does not guarantee future performance. Now, before I move to the next slide, what I want to highlight is there are about qualitative factors which we should consider as part of our investment, and quantitative factors or ratios which we should be taking into account before we invest into any mutual fund. So the first and the foremost thing to look at is the asset management company. Since you will be investing for a long-term perspective, you have to ensure that the asset management company's track record is good. What it means is that there are certain asset management companies which are experienced and have set processes, they have models in place, and they do have a good track record for some of their funds. What it also means that it doesn't mean that the new asset management companies are not good. What it means is the new asset management companies might have innovative ideas or certain different methodology for investing to ensure that the investors get a good return. So this is a balance which you need to attain on how much of it you want to give it to an experienced asset manager or how much of the bet you want to take on a new asset manager. The next thing is we are precisely betting on the chief or the captain of that fund, right, which is the fund manager. So the most important thing for us also as investors is to ensure that the fund manager, how is that person in terms of his analysis, in terms of his past record, how much returns he or she has provided. Look at some of his or hers videos, some of the material which they have provided as blogs or on their websites. This gives you a good indication of whether the fund manager will be able to deliver on the promise based on the fund's objectives. So this is another important qualitative factor. The third thing is, since the asset management company will essentially be a partner with you for another 3, 5, 10, 15, 20 years, it is important to understand what is the goals and objectives of the asset management company, which means whether there has been a consistent growth in their AUM, whether they have received some awards, recognitions, etc. from other entities. We should also look at some of the red flags, like have they been fined by a regulator or have they been doing certain things which are not as per regulation. Those things we should analyze before we go for a long-term investment into the asset management company. And the fourth and the most important aspect, I would say, is let's assume that I am hypothetically the fund manager and I'm managing a fund. How much of money is flowing into this fund for the fund manager to actually slice and dice the portfolio and align it to the goals and objectives set up in the prospectus. This is a key factor, because if the money is not flowing in, a fund manager might not be able to churn the portfolio as much as he or she wants to attain the goals and objectives. Obviously, he or she can sell some investments and rebalance it to another area, but I would say the money flow is an important factor into that fund. So these are 4 broad qualitative factors. Now moving into the next set of things is quantitative factors. 8 quantitative measures which we have considered as part of this presentation, and you as an investor don't need to know each and every ratio, but you need to know whether the number should be higher or lesser for you to take the investment decision. So let's look at the first thing, right? And this is essentially there on every website or any material you look at when you're investing in a mutual fund. So the first factor is actually annualized returns. In very simple terms, what it means is on an annual basis, how much return has the fund provided. So for example, you invested on 1st of January and you invested $100, and 31st of December, which is, I'm taking calendar year, it provided, the market value of that fund was, let's say, 110, which means the fund provided a 10% return. So you as an investor, you should look at this ratio called as annualized return, and the higher the number, it is better for you. So 18.52 is better than 15.87. The second thing also, when you are investing for longer term, you look at total returns. And some people tell me that, okay, if I invest my money right now, in how much time will it get double? This is what you will know by total return, right? So let's say if the fund has provided 200% to you, like you invested $100 and now it's 200. If it provided 200 in 5 years, which means you doubled your investment in actually 5 years. And this can be, it can be done for a specific period. So you can do it for 3 years, 5 years, 1 year, or any horizon you want. But it essentially tells you from the day you invested until now, what are the returns you have got. And in this case, it's again a very simple number comparison. So 18.52 is better than 15.87, okay, for that specific period. The third thing is you want to make sure that while you are investing in the fund, you don't want to end up paying a lot of expenses to the fund management charges, right? In a sense that, let's say if a fund gave you 15% returns, and the expense ratio of the fund is 2%, then essentially you only generated 13% returns because 2% will go towards the fund management charges. So in this case, when you look at the prospectus or information of the fund, look at what is the expense ratio. Obviously, there is regulation on how much expense ratio, there are caps to it, but the lower the better. In this case, with the example I have provided, 0.59 is better than 1.27. Let's look at the last ratio on this slide, and then we go to the few of the other quantitative measures. The last one here is standard deviation. Now, if you have a fund which is performing, let's say it gave a return of -5% this year, it gave a return of +20% next year, and then it gave, and again I'm going futuristic, but this standard deviation generally calculated for history, and let's say in year 3 it provided a -15% return. So what we are seeing here is the returns are very volatile, and what we want the fund management or the fund or the mutual fund you invested in has to have consistent returns, right? So let's say if it's 5%, 8%, 10% is better than a -5%, +20%, -25% return. And hence, standard deviation actually checks that. So in this case, a standard deviation of 0.5 is better than a standard deviation of 1.2, which means it's less volatile. Now let's look at the last 4 factors, which are very important. And this is called as Jensen's alpha. So what essentially it means is how much return it provided over and above the benchmark return. So for example, let's say hypothetically S&P 500 generated a return of 5% for 1 year, and the fund you invested in actually generated a return of 8.5% in that 1 year, in the same time horizon, which means your fund actually gave an additional 3.5% over and above the benchmark, which gave 5%. So in this case, it is the ability of the active fund manager to generate that additional alpha as compared to the benchmark. So again, as an investor, just check, the higher this number, the better. So 2.75 is better than minus 1.5. Can this number be negative? Yes. So if S&P 500 generated 5% return and your fund actually generated 3% return in the same period, then this number will be minus 2 essentially, which means you underperformed the benchmark, right? Quantitative measure number 6, this is beta. Again, this is similar to, I wouldn't say similar, but it's somewhat related to standard deviation. What essentially it means is, and this is how to know this is completely neutral. It depends on your investment style and your risk appetite. So beta 1 indicates that if the market goes up by 100 basis points, your fund go up by 100 basis points. If your beta is 2, if the market go up by 100 basis points, your fund goes up by 200 basis points. Again, if the beta is 2, if the market goes down by 100 basis points, your fund goes down by minus 200 basis points. So this is totally the risk and return formula. Investors who are willing to take higher risk can go with a higher beta, but essentially I would say the more neutral it is better. So again, it's totally up to the investor, so I wouldn't give any judgments here, but I gave you the perspective of what beta means. Quantitative measure number 7, Sharpe ratio. Now this is one of the important ratios. Again, what it means is how much of the returns were generated due to wise investment decisions and were not a result of excess risk. So the fund manager who's investing in different asset classes, Sharpe ratio actually tells you that the investment decisions were wise as compared to the fund manager taking excess risks to generate those returns. So in this case, again, 1.67 as a Sharpe ratio is better than another fund which has a Sharpe ratio of 0.37. And the last ratio we want to discuss here is called as tenure ratio. It is actually a performance metric for determining how much excess return was generated for every unit of risk taken by a portfolio or a fund. So if the risk was 1% and the return was 2%, which means excess return, it means that every unit of risk, the reward is actually double. In this case, for investors, if the tenure ratio is higher, it is better. So 1.67 is better than 0.37. So this brings us to the end of about 4 qualitative factors which we looked at and about 8 quantitative factors before you start investing into any fund, any ETF, any mutual fund. Now the most important thing is you would want to know, where do I get this information, right? We know what number to check, but how do you get that information? Thank you friends for watching the video until now. I hope in this content we have provided you some of the qualitative and quantitative factors which you should consider before doing investments into mutual funds. In the next video which I'm going to present, we will talk more about what are some of the websites to look at the information before you go and invest into these funds. So keep watching, and if you like our content, please like, share and subscribe our video. On that note, thank you very much and have a nice day.